What's going on? Alex here, and today we're going to talk about the real cost of income-driven repayment plans for student loans. And in particular, I'm going to be referring to 4 different repayment programs: IBR, income-based repayment; ICR, income contingent repayment; PAYE, which is pay as you earn; and revised pay as you earn. So those are the payment plans that we're going to take a look at. And this is particularly timely because the Biden administration has recently canceled $10,000 in student loans for a wide range of borrowers. So this topic is currently in the news, and it would be a good time to revisit and look at the real cost behind these student loans. And one of the services we offer at Efros Financial is financial planning. And we've worked with individuals and couples that have $100,000, $200,000, $300,000. Some have over $500,000 in student loans. And a lot of these borrowers are taking advantage of one of these repayment programs, which allow them to pay less than what the timely repayment amount would be, right? So instead of paying a loan off in 25 years, they pay less than what their payment is based on their income. And with that, they have some of the remaining debt after 20 or 25 years, depending on the payment program, forgiven, which means that they don't have to pay it back. The issue comes in when you realize that the debt that's forgiven under the tax code, the way it's currently written, is taxed as income. And this is generally applicable at the federal and state levels. So if you have $200,000 or $300,000 in student loans forgiven, now you're looking at that much in income in a particular tax year. And this catches a lot of individuals by surprise. And what often happens is that a student loan issue, when it's forgiven, then becomes a tax issue. That is why we're going to take a look at this. And I have a spreadsheet that's going to lay this all out for you guys so you could see these effects in detail. And this is an actual spreadsheet that I've used during planning engagements with clients to illustrate the differences in how these scenarios can play out under various circumstances. So with that, let's take a look at some of these repayment plans in a bit more detail. And you can see here that if you just Google IBR, ICR repayment plans, it'll take you to this financial aid website, and you'll see these plans laid out right here. We have income-based repayment, income contingent repayment, pay as you earn, and revised pay as you earn. Each one of them has different terms, but in general, it's based on the income amount that you make in a particular year. Of course, it's in some cases based on one spouse versus the other spouse, if they file separate returns and so forth. So there are a lot of different stipulations that come into play here. But at the end of the day, what you have to understand is that under the majority of these plans, you're paying, let's say, 10% of your discretionary income according to their calculation, or 15% of your discretionary income, right? So whereas a normal loan payment would be, let's say, $3,000 a month to pay these loans off in 20 or 25 years, whatever the term happens to be, in this case, you're only paying that 15% of your discretionary income. What that means is that you're actually not paying down your loan. It's in many cases growing because that interest that you're not paying is being added to the principal and it's being capitalized over time. So your amount of debt is growing, which means that when that amount is forgiven, you may be surprised by how significant it is. We're going to take a look at the spreadsheet in a second. One thing I do want to outline is that while I did mention those 4 loan repayment programs, public service loan forgiveness, or PSLF, does not fall into the analysis that I'm going to put together. The reason being is that the idea with public service loan forgiveness is that if you meet certain requirements, the forgiveness of the student loan is not taxable. Okay, so it's a totally different situation. It's just forgiven, and the idea is that in general, it should just go away. There should be no federal or state income tax implications under PSLF, but that's a very specific program, and I would venture to say the vast majority of taxpayers aren't working towards PSLF because it is very stringent and there are very specific requirements that go along with that. So while we're taking a look at the spreadsheet, just know that if you're working towards public service loan forgiveness, or PSLF, this does not apply to you in the same way, okay? So let's take a look at the handy dandy spreadsheet. You know, I always have a wonderful spreadsheet ready for you guys, and today is no exception. Now, this is, again, especially that we've used in planning, and the benefit of it is that we can play with some of these parameters in real time to illustrate to clients how significant a difference little changes can make. And we're talking about just the payment amounts that they're paying in a particular month can influence how long they have to deal with this. Okay, this could be a 10-year issue, 20-year issue, what have you. But the numbers really drive this whole evaluation. All right. So let's take a look at this. I know there's a lot on here, but it's really not that intimidating. What we're doing is modeling out what this loan would look like. And we have the number of years laid out here. So from 1 to 25, we're going to assume 25 years for this model. Then we have the year in question. So it starts with 2022 and goes to 2046. We have the beginning balance of the loan. Again, we could play around with this number, but we're going to start with $500,000, right? Because if the amount of student loans that you have is not significant, then you're not losing sleep over this, right? It's the clients that have 6 figures of student loan debt. They're the ones that are concerned about this the most. So to make the student loan amount $20,000 is not going to be worthwhile in terms of an analysis, right? The clients that are reaching out that have questions about student loans, they have significant balances and they want to learn how they can deal with it. So we're going to use $500,000 as the beginning balance. The annual interest and the payments are being calculated as well. The payments are coming from right up here. And I want you to know that if you run a software that calculates student loan payments, it's going to be a few dollars off because this is meant to be a quick and dirty illustration. It's not meant to be accurate to the cent, but it is certainly getting you to the ballpark. All right. So if you run the numbers by yourself, I know in the comments below, I'm going to hear, oh, wait a minute, I ran the numbers. It's a few cents off. Yes, it will be. But in general, the idea is still there in terms of illustrating what this can play out to be. All right, so $500,000 is the beginning balance, and we've run the numbers here, and essentially we figured out that 3511, spot 26, is the amount that you would pay for the loan to pay it down on time, meaning in 25 years, okay? So if we take this 3511 and just drop it into this monthly payment, we'll see here that as we go through this analysis, and again, we start with the beginning balance, we have some interest, we make some payments, again, quick and dirty, we see that by year 25, this balance is down to 0, all right? Meaning that we've paid it off on time. Now, what the spreadsheet highlights is the cumulative amount of the payments, which even by itself can be surprising to a lot of people because they don't understand that a loan of $500,000 over the 25 years means you're paying back over $1 million when you factor in the principal and the interest. All right, so this is not cheap. And for an interest rate, I'm using 6.8% for the assumptions. I know that they have recently dropped for student loans, but they can very well come back up. And at the time that I was doing planning for clients, that rate was applicable. So we're going to keep it there for now. The rate doesn't really matter by itself. The general idea is what I'm trying to convey here. So we're going to keep that at 6.8%. Now, we could play around with the monthly payment amount, and that's why we have these boxes here, and we're going to adjust that upwards or downwards so you guys can see the effects. And in terms of the forgiveness, we're going to assume combined federal and state marginal income tax rates of 35%, meaning that in the year in which there's loan forgiveness, we're going to simulate 35% as the tax rate when you factor in federal and state put together. It's on the high end because the forgiveness in some cases could be 6 figures. And when you factor that in along with the other income that taxpayers may earn in a particular tax year, then they very well may be subject to some of the higher tax brackets. And this 35% may even be conservative in some cases, especially if you're living in a high tax state such as California. All right, so with that, if we go through this model here, we could see timely repayment terms, meaning you're paying the full amount every month. You're not taking advantage of these income-driven repayment plans. You've paid over $1 million, but there's not going to be any forgiveness in this case, right? So you've paid it off on time. There's nothing to forgive. Makes sense. Principal and interest was all paid. Now, the estimated federal and state income tax liability resulting from the forgiveness is also 0, which makes sense because there was nothing forgiven. So that means the cumulative cost of these loans over the 25 years, principal and interest all in, you're looking at $1,053,000 $377 as the overall cost of these loans. Now, we're not factoring in inflation. We're not getting super fancy with the time value of money or anything. We're just talking in nominal terms, in today's dollars. So let's now play with some of these assumptions. All right. So we talked about $3,511 being the payment amount that you would need to pay this off on time. Let's see what happens if we start taking advantage of an income-based repayment plan. Now we're paying less than the full amount, resulting in some amount of forgiveness in that case, because when you pay less than your $3,511 a month, that extra interest is being capitalized. Let's assume that the monthly payment drops to $3,000. Okay, so looking at our spreadsheet here, again, we should be paying $3,511. Now we're paying $3,000. Okay, and as we work through here, that $3,000 times 12 is $36,000. You'll see how that all works through. And now you have cumulative payments of $900,000 in terms of what you actually paid in towards the loan. But what you could see is that now there's a remaining balance of $377,000 when this is all said and done. All right? And if we take that amount, we assume the 35% in the marginal federal and state tax rates upon forgiveness, we see that this adds up to $131,976. That theoretically is owed in the year in which that debt is forgiven. So you might say, okay, well, I don't have to pay back $377,000, which you're correct in that, but now you have $132,000 that you have to come up with. Where's that money going to come from if these loans were paid under income-driven plan, which means that these taxpayers aren't making all that much money necessarily compared to their amount of loans. So now they have to figure out where they're going to come up with $131,000. Fairly significant. Alrighty, so we can see there that when we add together the cumulative payments that were paid plus the expected federal and state tax amount resulting from the forgiveness, we get to $1,031,976. Pretty significant, but you have to understand that you have to come up with this $132,000 in that tax year. All right. Now, this is why I say that a student loan problem can, in many cases, become a tax problem, because there's this tax bomb waiting for clients at the end of the payment cycle when the loan is forgiven on the 25th year. Now, I know I'm going to get it in the comments below. People are going to say, well, student loan forgiveness is not taxable until 2025. Great. I'm aware of that. But after that, it's a question of whether it's going to be taxable or not at the federal and or state levels. There's a lot of question marks here, and you don't want to plan for it being non-taxable when it's been taxable for a number of years. Let's take a look at what happens if we take the payment down even further. All right. And if you're watching this video, like the video, subscribe to the channel, leave a comment down below. I love reading your comments because we're getting in depth here. This spreadsheet is very powerful in terms of illustrating what can happen just by changing the payment amount and how long a borrower is going to have to put up with this in their life. Now, going back to the assumptions, again, $3,511 is the total payment amount. We looked at what would happen if we paid $3,000. Now let's take a look at what would happen if we paid $2,500 a month. All right, so we're going to take this down yet again. So that means we're paying $30,000 every year towards this loan, and let's see what's happening. All right, so at $2,500 a month, we see that after making all of these payments, the balance is actually growing because we're paying significantly less than the actual monthly payment amount that would allow you to pay it off in 25 years. So after 25 years, you would have paid $750,000 towards this debt, which is not insignificant, taking into account that it started as $500,000. But now, look at this. You have a loan forgiveness amount of $746,000, which you might be saying, great, I don't have to pay $746,000. That's true. But if we assume the 35% combined marginal federal and state income tax rates, you now have to come up with $261,047 in the year in which this debt is forgiven. Now, again, I ask you, if these taxpayers were not making enough to pay their loans down on time, where are they going to get $262,000? Again, I fully understand that you can get on a payment plan with the IRS, with a majority of the states out there, and pay that amount over time. But it's important to take into account that it's just not going away once the forgiveness of the debt occurs. All right? And overall, you're still at the point where you're paying over $1 million for this debt of $500,000 that you took out 25 years ago. So this is the tax bomb that I find a lot of student loan borrowers are simply unaware of. They don't know what's coming. They know they're going to get forgiveness, but they do not plan for this bomb that's headed their way. And as much as they try to pay down the debt with as few payments as possible so that as much can be forgiven as possible, that creates an even bigger income tax event in the year of forgiveness. Okay, I fully understand that Congress could say, hey, you know what? Student loan forgiveness, it's just not taxable and never will be. They could do that, but they haven't. That's only been in place until 2025. What happens thereafter is anybody's guess. So when I discuss this with clients, of course, they're blown away because their student loan officer, their guidance counselors, and all those people at the college, they never told them about the fact that they're going to have to come up with $250,000 after they've been repaying a loan for 25 years and expected it to be fully forgiven. So what I tell some clients is that, hey, you know, even though you're on a income-driven repayment plan, that doesn't mean you need to necessarily stick to that low payment amount. Because while we're decreasing those payments and looking at what the effects might be, we can also increase the payments in our little spreadsheet here and see what those effects would look like. All right, so we were paying $2,500 and we're looking at having $745,000 forgiven. Let's see if we ramp up the payments and go above the actual payment amount. Let's go to $4,000. So now, instead of paying $3,500, we're paying $4,000, which in many cases is doable. You might be saying, hey, wait a minute. This person was paying based on their discretionary income, and now you're saying they need to pay even more than that. Where's the money going to come from? Well, you guys and I both know that if you file married filing separately, right, which means a married couple files 2 separate tax returns, in many cases, for student loan purposes, they will use the income of the spouse that is paying the loans. They do not include the income of the other spouse in calculating that payment amount, okay? So that creates an opportunity for married couples to say, hey, we're not going to pay less than the amount. We're not going to pay the 25-year amount. Let's get rid of this thing quicker and pay more. And in some cases, the spouse that doesn't have the loans may have significant income, and they might be able to tackle this thing very quickly and not have to deal with it for 25 years. So if we pay $4,000 a month, which is $48,000 a year instead of the $3,511, which is $42,000, again, not a tremendous difference in terms of lifestyle, you can see that this spreadsheet looks very different now. All right, in this scenario, after 19 years, we're popping champagne because the debt is gone. We've paid it off. And what's even better is that aside from the cumulative payments being lower, just under $900,000 now, because we put more money in upfront, now we don't have any amount forgiven. So we don't have to deal with those consequences of, oh, well, now a student loan bomb became a tax bomb. All right. And I said, look, with the couple that I was speaking to at that particular point, I said, you guys make a fair amount of money. $4,000 a month isn't going to kill you. And even more so, $5,000 a month, if you really want to push it, wouldn't kill you either to pay this down. So what happens? In this case, in 2034, we're popping some champagne right here because after 13 years, we've got rid of this whole thing and it only costs $763,000. All right. Before we were talking about over $1 million if you're taking advantage of the income-driven repayment plans. Now you're putting more towards the debt and you're killing the whole thing in 13 years. Finally, I said, look, guys, if you really want to get this thing squared away sooner rather than later, bump it up to $6,500. All right? I know it's going to be tough. It's going to hurt. It's going to be a rough few years for you. But overall, in less than 10 years, you guys are all set. All right? You're going to be popping some champagne in 2030 because your student debt is zero. And look at this cumulative payment amount, $679,000, as opposed to the over $1 million that we were talking about when we were taking advantage of these income-driven repayment plans. All right? And this opened their eyes because you could see that they have a whole number of years here in which they're not having to worry about, is it going to be taxable? Is it not going to be taxable? How much money do I have to set aside? All of this crazy stuff. They could just live their lives, all right, by tightening their belts and adjusting their lifestyle somewhat, significantly, but there's a return on investment. If we compare this to the other scenarios, there might be $400,000 here that they're saving that they would have been paying for student loans. And let's not forget that the interest rate for student loans tends to be fairly high, all right, which makes it even more attractive in terms of paying down. That was my point, in that essentially this payment amount can change a lot when it comes to student loans. And these repayment programs, IBR, ICR, pay as you earn, revised pay as you earn, they sound good. And in many cases, they're presented in a way in which it's not apparent what the effects are after the 20th year or after the 25th year, when this thing blows up and a student, instead of celebrating that they have no more debt, all of a sudden finds out that they owe $250,000 in taxes. And the IRS doesn't like to wait, and the states especially don't like to wait for that tax revenue. So they're not going to be just hanging out waiting for you to pay this down whenever you want. All right? In general, it's taxable income in that particular tax year, which means that in many cases, it must be paid by the following April 15th. Okay? So very important to keep in mind. I think that this is a good time with the fact that the student loans are being discussed right now. They're in the news. It's an opportunity to really take a look at these numbers, do the math, and find out, first of all, what the degree is worth to you. All right? What are you majoring in? Because a lot of colleges out there, they'll allow you to major in underwater basket weaving, and they won't hesitate to charge $250,000 for that. And we can see the effects here can be life-changing, life-altering completely. So it's important to not only assess the value of your degree and what you perceive it to be, meaning the $250,000 that it's going to cost you, but it's important to look at the overall cost. And you have to say to yourself, hey, this $500,000 debt might cost $750,000 or $1 million by the time it's paid off. Is it worth it? Am I going to get a return on investment? Or am I going to be anchored by this debt for the rest of my life? And this is going to be a source of stress that's going to force me to pull my hair out until I'm old and gray. All right? This spreadsheet I found to be particularly powerful with clients because it illustrates all this white space, all this stress-free living from a student loan perspective that they can have, as opposed to what it could look like if they really dig their heels into these repayment plans. All right, so something to consider. And before you get yourself in the debt, you have to do an assessment of what is it going to cost and what am I going to get out of it. All right, and colleges are getting real fast and loose with what they're charging, so you have to be more vigilant and careful in terms of how you approach this situation. If you have questions, we have the Efros Financial Power Hour live stream happening weekly, every Wednesday, 7 p.m. Pacific time, 10 p.m. Eastern time. And that is an opportunity to ask all sorts of different questions about different topics. And pretty soon we're going to have the ability for you guys to call in, ask questions that way. But for now, that's going to be the time for off-topic questions. If you guys want to tune in, I'd love to see you. Mark your calendars. It's going to be Wednesdays, 7 p.m. Pacific, 10 p.m. Eastern Standard Time. All right. Hopefully, this has been helpful in terms of taking a look at the real cost of income-driven repayment plans for student loans. If you liked the video, hit that like button, subscribe to the channel. All those things are free. All right? Leave a comment down below. I love reading your comments. And don't forget to tune into the Efros Financial Power Hour live stream every Wednesday. And as always, hopefully this was helpful. Thanks for watching.